Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 11th of June. I'm Daniel Lam, your host for the podcast. The US CPI inflation turned out not to be as alarming as many have feared. Headline inflation rose 4.2% year over year to a three-year high, with energy costs responsible for nearly 60% of the monthly increase. However, core inflation remained softer than expected, which is in line with the Fed's 2% target. Goods prices contracted and core services inflation eased, partly due to a reduction in shelter inflation. Real average hourly earnings declined 0.7% year over year, reflecting pressures on consumer incomes. Now, this softer core inflation suggests limited broadening of inflation pressures, despite oil price spikes from the Middle East conflict. If oil prices stay below $120 per barrel, we would expect inflation to peak in the second quarter of this year and gradually decline towards the Fed's 2% target by the middle of 2027. Now, new Fed Chair Kevin Warsh is likely to be holding rates steady for the rest of the year, possibly signaling hawkishness initially to maintain inflation credibility, while anticipating AI-driven productivity gains to eventually allow for rate cuts. The market reaction overnight, especially from equities, was negative. The S&P 500 fell 1.6%, while there was mild rise in longer-dated US Treasury yields. So yes, there were signs of re-escalation in the Middle East conflict. But you can see the bond market is now reacting less than the equity markets. Why is that? Well, the events in the Middle East and the oil prices would be the key drivers for yields, but the inflation report already showed that the broadening of inflation is still relatively limited. The rise in oil prices nowadays is much, quote-unquote, less panicky as we witnessed in the earlier days of the conflict a few months back. Rather, it is the factor that I pointed out in my podcast this Tuesday that had been driving the correction in equities, i.e. the psychological signal from equity raising, from the Mag 7 and the IPOs of their related companies. That suggests the AI CapEx cycle is entering an increasingly mature and capital-intensive phase, where even cash-rich hyperscalers are increasingly tapping external capital. Hence, we're expecting further but healthy pullback in equities over the next 4 to 6 weeks, which can eventually provide longer-term opportunities for investors. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.